Hello and welcome to this video on conditions that prompt trade. So in this video we're going to look at push factors and pull factors that might encourage a business to trade internationally, and then finally look at the concept of outsourcing and offshoring. So when we look around the world, we see over time, particularly over the last 40 years, an increasing volume of international trade. Now, what evidence do we use to have for that? Well, if we look at the volume of goods or the amount of goods traded compared to GDP, the trade to GDP ratios have increased for most countries. When we monitor the amount of money flowing between countries, we see that there are more movements of money between countries. When we look at companies buying other companies across border, we see that there's increased amounts of FDI. There are a rising number of global brands operating in different markets. We see increased specialization for different countries. We see products being made using global supply chains. We see lots of international labor migration. And we see increasing connectivity of people and businesses across different countries through use of technologies. So these are all evidence that the world is becoming more connected and there are increasing levels of international trade. So why are firms looking to expand internationally? Well, a number of different reasons. Perhaps to reduce their dependence on the domestic market, have access to fast-growing markets and demand in foreign countries, have a larger scale of operations and therefore benefit from economies of scale. We can provide a better quality of service to customers located overseas if we have a presence in that market, and we can build maybe a more global brand. And so often we describe the reasons why a company wants to expand internationally as being down to push factors, pushing them out of their domestic market, saying it's not good here, we'll push you away, go and be international to improve your fortunes, and sometimes pull factors, pulling us into that international market, reasons why we really do want to be in that particular market. So push factors are reasons where businesses feel they have to expand internationally because of issues at home, whereas pull factors are where businesses are attracted by exciting and compelling opportunities to grow by expanding internationally. So we're going to go through a number of these factors now. The first push factor is the concept of saturated markets. And a saturated market is one where sales growth has stalled or perhaps is falling. It means everyone really who's got one in this market or who wants one in this market has got one. So there's no scope for further growth. So it's difficult to grow in these markets other by stealing market share from competitors. There's no real growth in terms of the total market size. So a response to this is often to look for growth opportunities for the same product in overseas markets. So perhaps you have a market, a developed economy where the market's saturated, and the opportunity for growth is to move your product into a developing economy. So this would really be an example of Ansoff's market development. The second push factor is increased competition at home. So domestic firms may face with new market entrants who take market share in their domestic markets. And the result is lower revenues, creating a push incentive to seek revenues elsewhere. A pull factor might be economies of scale. If we expand overseas, we can increase the scale of our production, benefit from economies of scale, and reduce our costs, our unit costs in this example here from C to C1. This might involve offshoring production to lower cost economies, which we'll come on to this term a bit later. Another pull factor might be that by moving into a new market, we spread the risk that our business face. So Ansoff's matrix suggests moving into new markets overseas involves greater risk. However, trading internationally can spread the activities and revenues of a business over a wider range of markets, making the business less dependent on domestic demand. So if our country is seeing a decrease in demand of 25%, if we've expanded internationally, we might also be operating in a country that is seeing increased demand of 23%. And so our business is less risky, we're less reliant on one market, and we have a more diversified risk portfolio. Another pull factor is that expanding internationally may extend the product life cycle of our products. So if the marketing department feel we might be entering into decline, we can often promote our product or launch our product in perhaps a developing economy, and we can see the maturity phase of the life cycle extended. But obviously, will the product be successful in a new market with different cultures and tastes? We also mentioned earlier we were going to look at the terms offshoring and outsourcing. Now, offshoring is when a company literally moves its production offshore to another country, but it's still the same company. So offshoring occurs when a company uses another country to produce its goods or services. The new production facility is still owned by the existing company. So for example, when a car manufacturer in the US opens a factory in Thailand to make certain parts, they are offshoring, as everything is still happening within the same company, but we're now producing in a different country. This allows companies to take advantage of lower wage rates, production costs, maybe grants them access to natural resources, less stringent worker and environmental legislation, or perhaps lower tariffs and tax. However, it can lead to coordination issues and increased risks such as political risk and ethical concerns. Indeed, recently there have been some instances of what's known as reshoring. So for example, a UK business called Trunky, who make little children's suitcases, has brought production back from China to the UK so that production can be most closely monitored and it reduces transportation costs. On the right hand side here we see an example of offshoring. This is the Ford production plant in China, still owned by Ford but built and run in China. Now let's look at outsourcing. Outsourcing is a different concept, and this refers to obtaining certain services or products from a third-party company. So one company pays another company in another country to provide some sort of service for them, or to manufacture a particular part of their inputs. So let's make sure we have this definition down in our notes here. So for example, Apple may pay Foxconn to assemble their products. So Apple outsourced the manufacturing, or the assembly of their products to this other company, Foxconn in China. The advantage of this may be cost. The company you outsource to may be specialized in that particular service or manufacturing of that particular input, and also flexibility. I don't have to have a full-time permanent staff doing this. I don't have to invest in a factory. I can use this company, outsource the work as and when I need to. So in this video we've looked at the push and pull factors for international trade and looked at the concepts of outsourcing and offshoring. That's it. Thanks very much for listening.